Hey, good morning, everyone. Marty Missouri here. It's the 10th of March, 2024, with your weekly economic update. Folks, I can keep this one relatively quick, although I think it's an important one because it just continues to illustrate the mixed signals that are out there, but I think a growing pool of evidence that indeed the economy is weakening and indeed the chance of recession over coming months, let's say, are too high to ignore. In front of you is the simple graph of our PWA index. We dropped 6 points this last week to a negative 21. Again, the trend has been in the right direction, but that's a pretty good move lower. A lot of it was concentrated in the financial markets. I've been talking about how financial markets have been discounting strength in the economy. Well, that pretty much reversed last week, and I'll show you one chart that illustrates that quite vividly. So we'll look at a few inputs, just a few actually, and then I want to share with you some other things that I snipped from various resources. So we'll start with jobless claims. A little better than expected here in terms of the weekly jobless claims. Still 217,000, still just epically low historically. I mean, this is not adjusted for population growth. So that by itself denotes a very strong labor market. However, continuing claims continue to trend higher, and this is that labor hoarding idea that we've talked about here of late, and that is that after what companies experienced through COVID, couldn't find qualified people to put to work when business was picking back up, it became very, very problematic. Companies, therefore, don't seem to want to let go with what they have, even though, as you're going to see here, some more evidence of, there's some weakness that would typically lead to more layoffs. There's some evidence that we may be getting there in the months to come. The jobs data from the Bureau of Labor Statistics was out on Friday, and we had 275,000 new jobs created, which was actually 75,000 more than expected. However, the prior 2 months were revised down by a whopping 167,000. So on net, it was a disappointing jobs report. Then there's the household survey. And again, keep in mind, they interview establishments to get the 275. Then there's the household survey, which actually said that we lost 184,000 jobs. And that's the fourth month out of the past 5 where we've actually had declines. The labor force rose by 150,000, and so you put those two together and you end up with a higher than expected 3.9% unemployment rate. So folks, this actually gives some support for the Fed this year on balance, although again, it was better than expected, but when you dig into the weeds a little bit, it was actually not. And from one day to the next in Fed funds futures pricing, a rate cut in June went from a 68% probability, actually it jumped to an 80% probability. And nevertheless, the stock market had a rough day on Friday. And so we'll talk more about that, obviously, if it continues in the weeks to come. The ISM Services Index came out. Remember last week we talked about manufacturing. It went negative, but under the hood there were some positives. Just a slight downtick in the expectations of companies in the services ISM Purchasing Managers Index, but above 50 denotes expansion. But again, remember I said we could be getting a head fake in here, and I showed some historical context for that here recently. And I think that's not unlikely, to be honest with you, that we could see manufacturing turn and accelerate to the downside in terms of sentiment and have services follow, as they tend to do and as they absolutely will if indeed recession is on the horizon. And then I mentioned market-based, equity-based in particular, data. So remember last week we were down in negative territory in the staples to discretionary equity ratio, meaning when this goes down, discretionary stocks are outperforming staple stocks, which says something good about what the stock market thinks about the economy. Well, look how quickly that reversed. So now we're back to 3.5% improvement of staples over discretionary. Now, no doubt some earnings dynamics this week impacted this, but nevertheless, it says what it says, and that is staples are dramatically outperforming discretionary stocks so far this year. And again, staples are things that you got to buy if you want to keep living. Discretionary stocks are things you want to buy for fun or things that you spend money on when you have extra. And so this is key to watch. Some very legendary investors like Stanley Druckenmiller really focuses on such data to get a feel for the economy going forward. Okay, let me just pull over some things that I noted and cut and pasted. Fueling the notion that we have lots of mixed signals. Here's something that looks very negative on its face. Interest payments by U.S. households for consumer debt now is as much as they pay on their mortgage loans. So people are paying really high rates on their credit cards, for example, versus still low locked-in rates on their mortgages. Bears will roar about things like revolving consumer credit. Look how incredibly high it's gotten since, say, January 2021. However, when you adjust for inflation, we're just about back to pre-pandemic levels, maybe just a little bit above that. So not as bad as it looks when you look at it on a real basis, but again, something to pay attention to. And this is what you really want to look at in terms of what it says about the state of the consumer. The ratio of credit card debt to disposable income is still below pre-COVID levels. So relative to where we were pre-COVID, this still looks like a manageable situation, all things considered, which is why the bulls say that the bears are exaggerating and cherry-picking the data. And for the bulls, or those who are still optimistic about the economic state of affairs, you can look at U.S. household net worth. U.S. and nonprofit organizations is the way they report that. Net worth is just absolutely skyrocketed here of late. On a real basis, however, now this would be fodder for the bears, yes, it's higher on a nominal basis when you just look at the numbers, but when you adjust for inflation, actually household net worth has not caught up to where it was back in 2021, where we found the stock market's previous all-time high. And speaking of the stock market, households' market value of equities, mutual fund shares, etc., you can see they are very elevated as a percent of financial assets. So consumers, households, and nonprofit organizations are in the stock market in not small fashion. Remember what I keep saying about sentiment and how things can be when people are too loaded on one side of the boat. So something to keep an eye on. And then back to like debt as a percentage of net worth. I get that. I appreciate it. And it's true. It's not showing us a real scary signal. However, obviously, in a recessionary scenario, the debt's still going to be there. Assets are going to decline, and suddenly that does become a problem. And then just in terms of asset quality data coming from the banking sector, metrics were favorable overall, although deterioration is evident in commercial real estate and credit card portfolios. Weak demand for office space is softening property values. Higher interest rates are affecting the credit quality of refinancing ability of office and other types of commercial real estate loans. Folks, we came into this year anticipating like $500 billion of loans needing to refinance, clearly at higher rates than where they were originated. Well, it's almost double that. So there's a lot of pressure on commercial real estate in terms of this debt and the servicing of it as it rolls over into higher interest rates. This is commentary I borrowed from Peter Bookvar, by the way. As a result, the non-current rate for non-owner occupied CRE loans, so people who are not current on their debt payment, is now at its highest since all the way back to 2014, driven by portfolios at the largest banks. Also, the non-current rate for credit card loans is at its highest since 2011, and we almost dipped into recessionary conditions when we backtest our index back in 2011. That was around the European debt crisis. Didn't quite get there, though, and so we remained very long equities back then. The Challenger Jobs Cuts report was out last week as well. That's not part of our index, but we look at lots of different stuff. That rose 3% in February from January and is higher by 9% year over year. Challenger said with the exclusion of the first 2 months of last year, it is the highest January through February total since 2009. And their bottom line, as we navigate the start of 2024, we're witnessing a persistent wave of layoffs. Businesses are aggressively slashing costs and embracing technological innovations actions that are significantly reshaping staffing needs. The offset is the hiring side, of course, and Challenger said this on hiring. In February, employers announced plans to hire 10,317 workers for a total of 15,693. That's the lowest year-to-date total for announced hiring plans on record since they began tracking such things back in 2009. So, folks, this is a go-forward look at kind of the state of conditions and the state of the labor market. And this is a consumption-led economy, so we're talking about the state of the consumer, and that's what has our attention. In January, job opening and labor turnover report, the quits rate fell to the lowest since January 2018, not including COVID. Why is that important? Well, people do not quit their jobs when they're worried about their jobs. So a falling quit rate speaks to weakness in the economy. As for job openings, they were little changed from December at 8.8 million. That's still a lot. But the hiring rate ticked down to 3.6% after rising 0.2 the month before, just off the lowest since 2017, again, not including COVID. The S&P Global Services Purchasing Manager Survey came out. Firms continue to hire additional workers. That said, anecdotal evidence suggested that hiring was focused on part-time and temporary staff amid cost-cutting initiatives, and that also hampered total job creation. Rate of employment growth slowed to the weakest since last November. Service sector firms recorded the lowest level of optimism for 3 months, and one that was historically muted. And then lastly, I just wanted to touch on this. I read this in BCA's Daily Insights here late last week, and this confirms something that we said, I think, week before last, about the fact that, you can get all excited and the market can get all bulled up over weaker inflation data, which we expect because we see the economy weakening, and the market views that as positive because rates are going to come down and so forth. Well, the point that we made was that, that's true, but folks, as prices come down, as inflation comes down, this higher cost of labor, as one example, doesn't actually come down. And here they're making that point. Companies have a limited ability to raise prices as corporate pricing power remains weak. Even though wage growth has decelerated, they remain sticky. And the current disinflationary environment is causing selling prices to fall faster than unit labor costs, thus exerting downward pressure on margins. That's what we're talking about, is that this market is discounting fabulous things about profit growth, and it says that earlier in the snip. But no, not under a scenario where inflation comes down and wage pressures or wage costs or labor costs remain so sticky. We could get innovations in the AI space. Of course, long term, I suspect we will, but that's unlikely to lift anything meaningfully over the remainder of the year. Therefore, sales and EPS growth are more likely to disappoint than surprise to the upside, and that's our concern. Investors should position defensively in equity portfolios, but clients, we're hedging and we're staying fairly liquid, and we have things that aren't correlated to stocks in your portfolio. So, folks, again, mixed signals. You can focus on some of that more positive consumer credit data, how healthy the consumer is in terms of income and net worth relative to their debt. But when you sum it all up and you look at the current trends and the direction of certain things, you should be a bit concerned about the state of the economy. We don't know for sure what the future holds. Right now, we're not in recession. Economy's doing okay, but these forward-looking trends have our attention and have us continuing to exercise some caution in portfolios. None of this, by the way, is portfolio advice. This is just us helping where we can and giving our perspective on what's going on out there. Folks, thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.